Hello, everyone. Good afternoon, and thank you for joining the second edition of the Aluko and Oyebode's Insider Series. My name is Tamilore Oluwalaye. I am an associate with the firm's Banking and Finance, Private Equity, and Startup Practices, and I'll be the host for this month's edition of the Insider Series. Insider Series is an initiative of the firm's private equity and startup practices, and it aims to drive the conversation within the African startup, tech, private equity, and venture capital ecosystems. And we do this by spotlighting key players as well as stakeholders within the industry who are able to provide their insights to key issues and events affecting the ecosystems. And this month's edition of the Insider Series promises to do just that, as we'll be considering a very important topic affecting the startup ecosystem in Africa. But just before we get into the conversation and before I introduce our guests, we love our audience to know that we want this to be an interactive and engaging session. And so we encourage you to please type in whatever questions you have during the course of the conversation in the Q&A box on your screen. I'm sure that our guests will be more than happy to address your questions. And where we're not able to address the questions, due to time constraints, we'll post the answers to the questions on our social media pages. And also, in order for this conversation to be beneficial to everyone, a poll should be popping up on the screen right about now. Please take out less than 1 minute to complete the poll, as we'd like to have an understanding of whether or not you're a lawyer, a founder, an investor, really whatever it is you do, so that we're able to drive the conversation, to address matters that are of concern to you. So having said all of this, I'm very excited to get into this conversation, but first I'll introduce our guests. Our guest today is Olu Oyinsan. Olu is an emerging market seed stage investor. He's also the managing partner at Oui Capital, an early stage impact fund investing in promising technology companies in frontier markets, especially in sub-Saharan Africa. Prior to launching Oui Capital, Olu started his career in commercial banking with Nigeria's Guarantee Trust Bank, later working as a TEI consultant at Forrester, a global market research firm where he advised some of the biggest technology companies. He subsequently worked with the early stage practice of Silicon Valley Bank, supporting early stage startups across the East Coast of the United States. He holds an MBA from Alt International Business School, Boston, with a concentration in finance and strategy, and has been featured in Ventures Bond's list of 12 African VCs you should know. Hi, Olu, thank you so much for joining us and for literally living up to your firm's slogan by saying yes to our invitation.
Thank you very much. I'm very happy to be here.
Awesome. Okay, so let's just get into the conversation. But before we get into all of the conversation around startup funding, I would love our audience to get to know you. So I know that you started out in commercial banking with Guarantee Trust Bank, and now you play in the private investment space as a VC. So I'd love you to just give us like a brief background about yourself, your career background, how and why, you made the switch from commercial banking to the private investment space at the time when you did.
Thank you very much. So I think I'm one of those people that can tell you that I've pretty much spent all of my life doing either business or finance, right? My first degree is in business and accounting. Of course, my master's degree is an MBA. And I worked in and out of business, finance, now technology. I started my career basically creating, I would say more like structured finance products, right? And if you know, yeah, banking doesn't have a good rep, right? But it's a very good foundation for understanding the flow of value, right? And understanding how risk affects business cycles, right? And that's why it doesn't have a good rep, because banks don't lend if the money isn't coming back, right? Which is probably not the best way to approach business, because business is the asset of business is risk, right? So I would, after my first degree, I would end up working for GT Bank for about 4 years, structuring loans. I worked across Lagos, Abuja before I moved to the US. to get my MBA and work some more. And then I came back again. So I think what really would drive me away from purely debt, right? Because the truth is, now I play on the equity side. Before I would play on the debt side. They're both very important parts of the capital structure and play very different and distinct roles and very important roles, right? I just thought that an interest rate was not enough value to be extracted from a business that you took some reasonable risk on. And an interest rate wasn't enough reward for being creative in like structuring funding for businesses. So you would, for someone like me, you would want a more partnership-oriented participation in a business where you share of the benefits of the upside, right? And reduce your protections for the downside because you're in this together. And that's probably why I do private equity today, right? Venture capital is a type of private equity. It's not public. So that's kind of why I would move to the equity side, because if you feel you're creative at helping businesses grow, you probably want to be in the game, have skin in the game, as they say. And so I guess that was my attraction for playing on the equity side.
Thank you. I mean, it's interesting that you spoke about VC being like a subset of private equity. And I think that brings me to my next question. The truth is, not many people, know what the job of a VC entails. Prior to the Twitter ban, if you follow like startup conversations and all of that, you would see that venture capitalists and venture.
You still don't follow them?
Is that?
I say you still don't follow them.
Well, but you know that venture capital.
That's a story for another day. Okay.
You know that venture capitalist and word venture capital is like such a buzzword, right? But the truth is, not many people are actually familiar with what a VC does. Some people think that VCs are like super loaded guys, ready to cut the next check for the next startup. And I know that what you do as a VC is a lot more than that. So could you just tell us briefly what your job as a VC entails? And really, I think for the benefit of people who are not very familiar with the private investment space, if you could just clarify the difference between, a private equity firm and a VC firm.
Okay, cool. I think first of all, I would start by explaining what a VC does, right? And then we can use those characteristics to drill down into the differences, or how to recognize a private equity firm different from a venture capital firm. So what do VCs do? Let's go back to rudimentary. VC means venture capital, right? And this is how I want you to remember it, right? Take venture. Usually when people say they're doing a venture, or even use the word adventure, root word, right? Adventure gives you a sense of something that is, there's a leap, right? You're not sure of the outcome, right? But you have some optimism, right? So if you say you're going on an adventure, it tells the person you're talking to that you don't really know how this is going to go, right? But you have some sense of what your intended destination is, right? And so I want you to always, just as a layman, I identify adventure and venture capital in very similar terms, right? So when you say you're going to build a business venture or you're going on a business adventure, it's a risky endeavor, right? You don't know how it's going to go. And of course, as we noted before, a bank is not interested in adventures. And that's why they ask you to bring them 3 years of your bank statements, because they want to establish history. They want to establish historical track record. And if you've been doing something already, it's no longer a venture. So what venture capital does is the capital for taking adventures, basically. So someone needs to give you that money to
Mm.
venture into the wild. And that's what venture capitalists do. And venture capital came about because there was a space in the funding gap. People realized that ideas were going from small to big. And the people who dared benefited. And it was clear that there was an opportunity in businesses that didn't look like traditional, established, successful businesses. And so an industry or a financial instrument came out of those kind of successes to say, hey, let's create something that's actually dedicated to funding dreams, right? To funding adventures. And that's how the venture capital asset class came about, right? So what we do as VCs is to fund ideas that don't look like they're going to obviously succeed, basically. And there's a whole practice around that, how to mitigate our risk, how to take advantage of the success, how to partner, everything that has in between, from funding to supporting to making sure that that adventure turns out in the right way. That's what VCs do.
I think I definitely like your use of saying that venture capital is like supporting an adventure, like provision of capital for an adventure. And I've never thought of it that way. So I think that's like really interesting. So I'd like to know.
Yeah, to your second question about private equity and venture capital. So this is very nuanced, right? You know, the way for biology people, they say mutualism is a type of symbiosis, but symbiosis also means you guys are working together. So it's kind of weird, but so venture capital is a type of private equity, right? So let's start. Usually when you trade any security that is open to the public in a public company, in Nigeria, we call them PLCs, right? That is public equity, right? So anything that involves injecting money into a company or buying company shares that are not publicly traded is private equity, right? So that's the first. And then inside private equity, because private equity was around much earlier than venture capital, inside private equity, they would fund companies that have track record, big companies that are not really an adventure, as we said, right? And then venture capital is a subset of private equity that actually comes in at a riskier and early stage, right? There are a lot of nuances for finance people, but usually a private equity firm is usually bigger in capital, come in at later or growth stages, right? And are not willing to take the kind of risk that a venture capital firm would take, right? Venture capital companies are almost miniature private equity firms. One, in the way they're structured. Venture capital firms are structured very much like private equity firms. But the nuances, the type of people, the type of personality, that the kind of mindset you take into venture capital must be accepting and comfortable with risk. Much more risk, right? Private equity is a lot like banking in terms of the risk appetite. Venture capital is much willing to take a risk, and we're cooler. Let's just say that.
Thank you, Olu, for that. So, I mean, now we know that venture capital firms would typically get involved at a very risky stage, where the firm is about, where the startup is, going on an adventure, and there's no certainty as to their success. Whereas a PE firm will step in when there's like track record and all of that. Thank you, Olu. So I think this brings me to my next question. So as a VC and as an investor, I'd like to know the key indicators you would typically look out for prior to taking that decision to say, you know what, I'm going on this adventure with this startup. I'm going to back the startup. So I would like to know what the key indicators are for you prior to taking that decision to say, I'm going on this adventure with this startup.
Okay, so this is me trying to compress a whole industry, a whole learning, a whole career into probably 2 minutes of what people look out for. So first, the basis is, as a venture capitalist, even though you're putting money in a company at a risky time, right? The aim is always to make sure that that business is successful. And what makes great venture capitalists is that they keep making bets on businesses that eventually become successful and big, right? So there are a few things that venture capitalists look at, right? First one is usually the product, right? What is it that you are bringing to the market? Is it a product that consumers want? Is it a product that consumers will buy, right? So we have a term called dead on arrival. It's usually an inside term when there's a product that doesn't quite fit the need of the market they're going after, right? Yeah, so it's like someone coming to sell winter jackets to you in Lagos. You're not even going to go into anything else, right? You know, this is DOA, right? Or they say, yeah, we're launching this really cool brand of winter jackets that can glow in the dark, that can, before you get into all those things, you know the product is wrong, right? And it would never get to a point where we call product market fit, right? Where the product and the market are a fit, basically, right? There are a lot of nuances that determine when a company has gotten to product market fit, but basically that's the concept. The second thing we're looking at is the team. And this is actually the most important, right? It's firstly, who's behind it, right? In our firm internally, we actually have a 52-point metric where we kind of take out the bias in decision making and create point-based allocations to each of the things that we look at. So if I tell you there are 52 things, it shows I'm trying to pick some of the most important things, right? So the question is, who's this person? And why are they uniquely positioned to deliver this, right? So for example, there is new technology out there testing, let's say, for example, testing for cancer cells in 10 minutes, or someone is about to develop that technology. If you came to me and someone who had a degree in biochemical sciences and had some experience working on some type of testing, right? It's more likely, not impossible, it's more likely that that person has the knowledge it takes to carry that project over the line, right? Unlike someone who spent their entire life getting their BSc and LLM and LLM or whatever you guys call it, right? Who's spent their time working at a law firm. So that's very important. Also, we want to look deeper into the chemistry of the team because teams break up. Startups are hard, right? And just like a marriage, as they say, love is not enough. So you need to figure out, are there dynamics that will keep this team together through tough times? Do they have complementary skills? Are they likely to stay together for a long time? And that's why we go into things like vesting agreements and figuring out what the equity split in the company is amongst the founders, what kind of balance it is in both thinking, in both diversity of background, sometimes even gender, right? You're looking, is this a balanced team? Can they carry it across the line? Another thing we're looking at is market. And this is very important. This is the difference between venture capital and traditional, any other type of private equity. At the early stages, we want to figure out what we call the TAM, right? Which is a short form for total addressable market. Basically, because we're taking so much risk, we want to make sure that the upside is very high. And the upside being high means there must be a large total addressable market. And I'm sure you must have heard about the dynamic between risk and return, right? And so if we're going to take so much risk, there must be an opportunity for so much return, right? Because this is how VCs balance their portfolio, the risk in their portfolios out. And so a lot of times, people approach VCs and say, I have this brilliant idea, right? And it is actually brilliant, but the market isn't big enough, right? Especially in some African countries where people are selling, for example, you create, and this is subjective again, you create the kind of app that exists in the US for maybe mental health or helping you to sleep. There's an app that's a unicorn called Calm today that helps people in the US to sleep, right? It helps you to sleep. And that's a beautiful idea if you're coming to the African market. The question is, how many people would download and pay monthly subscriptions for an app that helps them to sleep? Are they in the millions? Maybe. Are they in tens of millions in Nigeria? No. And so at that point, even if everything else is right, we have to say the TAM for this is too small, because almost about 80% of the businesses, because of how risky venture capital comes in, about 80% of the businesses that a VC invests in are going to fail. And so if one or two do well, they need to do very, very well to cover for the losses of the rest. This is how we keep the industry going and keep dreams funded. And so if this dream or this idea cannot be a big idea, if you cannot sell to a lot of people, right? VCs are usually not very excited. And that's why there's usually some confusion. People say, oh, I have this great, maybe fruit manufacturing business, right? That's doing well, I'm making a profit, but VCs are saying no. And that's not because you don't have a good business. It's because they haven't seen that trajectory. The market needs to be there, and that business needs to be going very fast. And this is why it looks like VCs have a bias for tech-driven businesses, right? Because tech-driven businesses are businesses that can scale very fast and reach a lot of people in a short time without having those distribution bottlenecks that you usually have in other businesses, right? If you create something that is good, people around the world would use it without you having to physically sell it to them, as long as it goes viral. For example, you can sit there and download and purchase from any store that you like today, all right? Or you can download any app and pay a subscription. And so that's usually how, those are main three things that VCs are looking at, right? The team, the product, the market, very, very important. And then a lot of other things that probably can be worked around.
Thank you, Olu. I was actually going to ask a question as to why you invest in tech companies, but I see that you've answered that, due to the ability for them to scale easily. So I'm just curious to know, aside technology, right? What do you think, in your opinion, what do you think the next gold mine would be for investors? So what other sectors do you think in the coming years would attract investors' interest and focus aside technology?
So I'll tell you what I think, right? Technology is not an industry or a vertical. Technology is what every industry or vertical is going to run on. So tech is here to stay, right? And how technology will be applied is now the question, right? So you see companies like Goldman Sachs that used to be banks, they're now technology companies, right? You see companies like Olu Oyinsan, who would never have run a panel like this before 10 years ago, right? So yeah. Tech is how we live, right? And then all other sectors build on top of it. So it's basic. Now you get into even the most engineering things like a car, right? Now you get into a Tesla and you feel like you're driving a computer. literally, right? You feel like you're driving a computer when everything around you is a button, you can hands-free, drives by itself. And so tech is the future of everything, right? Look back 20 years ago, right? The 10 most valuable companies in the world, right? None was a tech company. Today, about 7 of those, right? So tech has changed the game, and it's just how we live going forward. Everything was technology from the Industrial Revolution. Now we're in a place where we just digitally automate everything, and that's the future. So it's not really an industry or not. What we'll now be asking is, what industry in tech, right? Is it automobile? Is it financial services? Is it data science? Is it robotics? What is the next phase that they're using technology to build? So that's really how I'll say it cuts across everything and it's the future.
Thank you, Olu. I think I would just like to remind our audience that the Q&A box is just right in front of you. If there's anything Olu has said that you think you need clarification on, please feel free to type in your questions. I'm sure we're more than happy to address your questions. So I'd like to consider, startup and investment from a regulatory perspective, right? You agree that there's been a lot of regulatory activities in Nigeria, particularly with regards to fintech companies and tech companies. So as a founder, how do you think founders can navigate the unique regulatory risk of building a business in Nigeria? And also from an investor's perspective, how do you think investors can protect themselves against the regulatory uncertainties of investing in startups in Nigeria? Because regulatory policies, being churned out daily, they kind of have the potential to kill a business model. So how can you as an investor protect yourself against the regulatory uncertainties?
I don't know if I should use the word protect, right? Because the currency of return is risk, right? I would say manage as an investor, and I'll tell you how as an investor and how it's different from a startup, right? A startup is usually a singular entity in the sense that the way my life as the founder of a venture capital firm and the way a founder's life will be built is quite different, and we have different risk profiles, right? A startup founder is usually building a single company, right? Building a single company, most of their net worth is inside the value of that company, right? They spend all their time building that company. They're obsessed about it. They stay awake building it. For example, at the firm today, we have about 14 portfolio companies spread across Africa and the US. And so I obsess about these 14 companies for now, right? Tomorrow, there might be 15 or 16. And so our lives are quite different. The way I think of regulatory risk is different from them. So for a founder, it's unfortunate, but it's a lot more difficult. And that's why one of the major financial risks that anybody identifies is what they call sovereign risk, right? And just talking more about the public equities, right? Countries have what we call risk ratings, and organizations have what we call risk ratings, right? The AAA, B up to like junk. And one thing you notice in how companies like Moody's or Goldman Sachs rates risk ratings of companies is that your risk rating can never be higher than your country's risk rating. And that's for a reason, because there's something we call sovereign risk. And from the word, when you say something is sovereign, it means that you can't hide from it. It's going to affect you. So a lot of what you want to do is inside the sovereign risk, try to maneuver your way out, right? So what you usually want to do is look at the patterns, right? And this is at the point of deciding where to launch your venture. either in the vertical or in the geography, right? And try to assume how much risk do I think we're taking. For example, in our 52 point metric, there's a place where basically whoever is analyzing this investment has to ask, does this company operate in a regulatory gray area, right? A lot of times gray areas are where you know there might be risk, right? But we're not in the business of running away from regulatory risk. For example, a lot of the very successful companies started in gray regulatory areas, right? Companies like Uber, and they still fight regulatory risk in almost every country they go to, right? But that's what great ideas are made of and great businesses are made of. But a way to just figure out is to do deep research on patterns, right? On historical regulatory movements in that country or that space, right? And try to figure out, what do I think the risks are going to be in the future? And how can I build my business model around it, right? Finally, or invariably, countries that are seen as more risky regulatory-wise are going to lose investments to countries that are more stable. This is just how it goes, right? That's why you see a lot of Nigerian companies are registered in Delaware today, right? A lot of Nigerian companies are moving their operations to Ghana. Foreign companies like Twitter are moving their operations to Ghana. It's not because they don't like Nigeria. It's just because the environment is unpredictable, right, to a large extent. So I think as a founder, what you really want to do is you really cannot mitigate this risk, especially as a founder. All you want to do is try to manage it, right? But there's something that's very special about people who eventually go and found startups. And it's almost a DNA thing. People know how to go around problems. So a lot of times you see companies like GoCada, where there were regulatory uncertainties that were supposed to kill them. But the DNA of a successful startup founder is that they always find a way, right? So you cannot overplan it, because then it takes the risk element away. But you must create a business model that can pivot very quickly to adjust to regulatory risks. On the other hand, how we manage regulatory risk on the financial side is very different. We use something called diversification, right? So for example, we have a portfolio of companies in Nigeria, Kenya, Ghana, South Africa, Zimbabwe, Mauritius, and the US today. And we're not just fighting regulatory risk, we're fighting a lot of things, right? Sovereign risk, financial risk, demand risk, FX risk, which can be tied to regulatory, right? And so when you are building a portfolio like that, there are a lot of things that now come in play as a fund manager, right? You have to make sure that all your gains cannot be wiped out because someone woke up on the left side of his bed, right? So you have to make sure that you create a portfolio that is quite balanced. It's hard for all these countries that I mentioned to be experiencing this currency slide that Nigeria is experiencing today at the same time, right? Because a lot of them, the currencies are hinged on different products, right? Different commodities. And so when you create that across currencies, across geographies, it helps you manage risk as an investor. For example, at our fund, we almost have an embargo on Nigerian investments today, right? Nigerian investments don't rank on the top of our attractiveness list today, despite being Nigerians. It's just because no one wants to do business to throw away their money. And so unless it's in a place where we're sure that, okay, the regulatory risk here is less pronounced than other sides, then we will look at it a little more. But that's how fund managers or VCs usually manage their risk.
Thank you, Olu. So, I mean, you spoke about, at least on the investor side, diversification, and for founders, conducting like a research on the historical sovereign risk and trying to build around that and basically being innovative in order to re-strategize. But while you were speaking, you actually spoke about something I was going to ask a question on. You spoke about, startups being registered in Delaware. And I was reading a book called Ventures Deal, where I think the author had alluded to the fact that as a startup, if you're going to attract investors, funds, VC fund, you have to be registered as a C Corp in Delaware. Right. So I would like to know, at least from a founder's perspective, are those the sort of things that, in order for you to, take that decision that you're going to, put your money in the startup, are those the sort of things that you love to see in place? Are those sort of corporate structures you would love to see in place for a founder you're looking to invest in?
So the short answer is no. Right. Oh, by the way, the book Venture Deals, I think is one of the best introductory books for venture capital. It was actually written by a man named Brad Feld, who's actually, ironically, is one of Oui Capital's investors. Yeah, so if you're nice to me, I'll introduce you to him. And it's a really good book, but it was written in not as global a context, right, as we operate in today, right? And so majorly what he was trying to say is that company structure, incorporation really matters, right? And there are two things, in the words of the book, there are two things that investors are looking at, right? In terms of safeguarding their investment. One is economics and one is control, right? And as a lawyer, you would know that they're very certain, there's some certain kinds of company structures that don't allow for free flowing economics or control, right? And so what you're looking at as an investor, right, are a lot of things. Just figuring out, they all tie in together, right? Even sovereign risk, regulatory risk, and then corporate governance, which has to do with control. So some some entity types allow for more decentralized, some don't. And this is all we're usually looking for, right? Fortunately, after the Jobs Act in the US, right? The Jobs Act is a list of laws. It means, I think, jumpstart our business jobs, jumpstart our business systems or something like that in the US, right? It created a bunch of laws that would really encourage how startups get funded, because they realize venture capital is a big part of our financial system. And I know that Kama has recently, that's in Nigeria, has recently made some adjustments, some interesting adjustments that look like the Jobs Act. So kudos to the government on that. So those kind of things encourage venture capital investors to not only look at Delaware. What Delaware just did is that they took advantage of an opportunity much, much earlier than most other people and said, we want to create, and that's what visionary leaders do, right? We want to create a hub where every startup wants to be incorporated, right? So lowest franchise taxes in the country at the time, right? Created very favorable laws, things like arbitration and jurisdiction for settling disputes, right? And so it made it a destination of choice for both investors and startups, because they're like, Delaware understands our business, right? Today, Delaware still enjoys that reputation, even though it's probably not the most friendly state anymore in the United States. Some states have caught up, but Delaware just has the name already. And so we do not, even though our fund is a Delaware fund today, right? We're totally a US-based fund in terms of our structure. We're structured as a limited partnership, but we invest in all sorts of structures, right? But the reason why it's Delaware C Corp is on top of the attractiveness list is, first, it allows a lot of shareholders. One, it allows a lot of share classes, right? Which are a lot of things that are not captured in the CAMA or in the laws of many other countries. It allows for shared classes. For example, a venture capitalist usually likes to come in and take what we call preference shares because it gives them downside protection in case things don't go well. And so Delaware had created something that fit right into what we were trying to do. So for example, as I said, it lets you have many shareholders. It creates allocation for very different share classes, right? It's very easy to register, even for people that are out of state, right? The taxes are really low to encourage entry. That's in the beginning, at least, right? They'll catch you on the back end. And so those things make it very easy to go there. And a lot of lawyers and service providers like accountants, CPAs had specialized in Delaware. And so that's what made it very easy. But we look at company structures on case-by-case basis. But yeah, it will not be a Nigerian limited liability company. Those things, yeah, it creates some encumbrances that investors do not like.
Thank you, Olu. Just to remind our audience again that the Q&A box is open. If there's any question you have for Olu, if there's anything you want him to clarify, I shall be more than happy to address your questions. So, I mean, this is a law firm, and I have to ask some law-related questions. So, I know you've collaborated with a number of foreign law firms, given that you have portfolio companies in different countries, right? So, based on your experience, is there any particular feedback you can provide to Nigerian law firms in terms of the services being provided to founders as well as investors? Do you, in your opinion, think that there's a disparity in the nature of services provided by Nigerian law firms and foreign law firms that you've collaborated with?
Are you sure I want to answer this question on an A&O platform? Are you ready for the answer?
Yes.
So I'll keep it nice and
Wow.
very and just very general, right? In fairness to local law firms, right? Venture capital hasn't been around even half as long as it has been in places like the US or Europe, right? And so I would say that the law firms, I've had the pleasure of working with in fact, most of the law firms, right? Big, small, boutique, is that most are still on a learning curve, right? What we saw as private equity practice, even inside law firms, right, was more of transaction structuring, not really an understanding of private equity as an asset class, right? So what you saw was transaction agreements. And that's why you would engage with a lawyer who's probably supposed to have 15 years in private equity. And then it's hard for you guys to communicate because probably only one or two partners in the whole law firm really understand the full gamut of how these things work. I don't know if it's done on purpose so that lawyers won't keep leaving to start their own firms, right? So they just break the work into pieces and nobody really understands the full transaction, right? But we're seeing an improvement, right, in how lawyers are handling venture capital transactions. But today, truthfully, I haven't, except some boutique and smaller law firms who had some experience in more developed venture capital markets. I think there's still a lot of room for improvement. But the willingness to even host a webinar like this shows that there's the enthusiasm to cover that ground, right? And I think we will get there eventually, right? But it takes a willingness to learn and almost forget. It's almost like forget and relearn, right? And so that's what it is today. And yeah, it's not there yet, but it's getting better every day.
Interesting. I mean, I don't know how to. I mean, I definitely hear you on learning and relearning. And I think that all the lawyers on this platform are definitely willing to do that, even by just joining this webinar to hear from you and to get an understanding of, venture deals and all of that. So I definitely hear you on that. Okay, so I'm just going to move on to like.
And by the way, I've conducted a training before for lawyers on another platform. This was 2 years ago. So if you have enough numbers, I'm willing to do a master class.
Awesome. Awesome. I'm sure we'll take that. I'm sure we'll take you up on that offer. Okay, so I just have just to end before we go on to the Q&A, because I see that we have a number of questions, just to end this on like a lighter note. I would like to know, what's the best investment advice you've received till date?
Investment advice. I think it is that investing in people is the best investment, right? Investing in people is the best investment. Even the guys in finance know this, right? When I was in banking school, there was something they called the 5 C's of credit. I might not remember all of them, right? I think there was collateral, there was capacity, there were a bunch of things, but there was one called character, right? And the good bankers know that character is the most important you look out for, even outside collateral or capacity to pay, right? And same applies on both sides of the equity capital structure, right? You're investing in people. So if you make investments that are driven by the right type of people that are supposed to affect the lives of the right kinds of people, that's the best investment. Everybody wins.
So just at the back of that, I would also like to know like the common mistakes investors make. So I came across a tweet where an investor was talking about, investing based on the fear of missing out. So in your opinion, what are the common mistakes investors make?
There are many. And the truth is, in life, it's a learning process, right? And let me tell you, investors are usually 70% of the time wrong. The great investors, if you can be right 30% of the time, you'll be a legend, right? And so I won't really say you can quantify the mistakes you make, because a lot of failures are subjective and are based on things that you cannot really control out the door, right? But personally, I think a very basic mistake people make is investing in things they just do not understand, right? And sometimes what you said, FOMO, fear of missing out, drives it. But the truth is that FOMO is a good emotion, right? It's a good emotion. It drives you to do things so that you wouldn't regret. But it has to be balanced out by knowledge. And that's why you might notice people who buy, speculate, and sell cryptocurrency, right? A high percentage of them do not really understand cryptocurrency, right? They've seen people make money. They run on speculation of market makers or influential people, jump on bandwagon. So they cannot really tell you when they're going to make money or when they're going to lose money, right? Because in the sense, most of the things built on the blockchain were created for use cases. And you now have a speculatory market where things that don't even have strong use cases are going up and down in price, right? And that's why there were a lot of tears when some coins started losing value, because the people who bought it didn't understand what made these things gain or lose value, right? Or the fundamentals behind it. And so if you don't understand it, it's already a mistake. You might get lucky, but it's already a mistake. So I would say, yeah, just to keep it simple, investing in things you don't understand is probably the biggest mistake you can make.
agree. I definitely agree that you should actually take our time to understand what you're investing in before you put your money in there. So I'm just going to imagine that I have like $500,000 million sitting somewhere, and I'm looking for how to invest. So I'm going to ask you how you're going to invest my $500,000.
Unfortunately, that counts as investment advice, and I'm
Wow.
regulated by the Securities and Exchange Commission. So
Wow.
I'm not allowed to do that. In case you go and take that advice and you lose money, you can sue me. But I would say you do research, right? Investing in startups is a good, of course, I'm a proponent of that. Investing, go and look for your friend's company who has a good character and has those three things I spoke about, and give him some of that money. You can invest in the stock market, follow companies that have strong fundamentals. There are two very basic ways of investing in the stock market. There's one we call fundamental analysis. There's another one we call technical analysis. So fundamental analysis, basically you invest in UAC foods because you eat gala in traffic every day. You know that this is a strong brand, right? And I can back this brand and I'll keep eating gala anyways, right? Or technical analysis, more if you're good with data, look at how they've done over many years, how they've done over seasons, and try to compare what's happening in the market with what their future might look like, right? For example, a lot of people in the US are investing in renewable energy now because they know that that's where the government's focus is, right? By 2045, they want no emission cars. So it probably makes sense that if everyone is going to be driving a no emission car, let me go buy maybe Tesla stock, right? And so that's a good place to start, right? And that means I've given you one private equity idea and one public equity idea, right?
Thank you, Olu. I mean, I hear you. So we're definitely not going to, you've given the disclaimer already, so it's not like we're going to hold it to your word. Just as a last question, I'd like to know what is the greatest pleasure of being a VC? So you've been doing this for some time now, and I'd like to know what the greatest pleasure of being a VC is.
So first of all, let me tell you, VCs are poor, right? If you're going into VC because you want to be rich, you should probably go and start a tech company, actually, instead. VCs have higher highs, or rather, VCs, tech founders have higher highs and lower lows. If it goes well, it will go very, very well. If it goes bad, it will go very, very bad, like to nothing. That being said, I think the greatest pleasure you get from being a VC is watching the creative process, right? There was a company that I invested in late 2018, right? And what the founder brought to us was just a deck, right? A pitch deck on a computer, and said, this is what I want to build. It's never existed on the African markets. We weren't even sure how it would play out. But the team had a strong character, they had experience, and from our knowledge of the market, this was a need. It could serve a lot of people, and it could do very well if it went well. And so we invested at a deck, and then helped this company to even go and poach their first CTO, right? Those are the kind of things that VCs help for. By the way, CTO means Chief Technical Officer, the guy who writes the software or leads the software team. So from a presentation that someone showed you without a company, I think that company today is on to make a revenue of about $4 million this year, right? And so when you just watch that creation of nothing to a strong company, I walk into their office and I see employees scattered everywhere, right? Like I think they're about a team of 30 now. it gives you a satisfaction that no one can explain. And you see their numbers basically from zero, right? The downside is sometimes you receive emails of founders that you back like that will tell you, hey, we're shutting down the company, it's not working. So it's two sides of a coin. But I think that's actually the most rewarding side of being a VC, watching somebody or a team's dream being actualized because you took a bet on them. It's very rewarding.
Thank you, Olu. I mean, I think it's been a very insightful conversation. I know that we have a couple of questions which we would have to run through briefly because of time. So I will just read out some of the questions. And so Oladimeji Akindele says, hi, Olu and Tammy. Debt, equity, and mezzanine and convertibles are some of the structures used by VCs. Would like you to share your thoughts on which is more expensive, debt or equity, from the perspective of both the investor and the investee.
Okay. Oladimeji, thank you for that question. Very good question. You spoke like a finance guru. First of all, I'd like to say that debt and mezzanine are not really tools that VCs use primarily, right? They're not one of the most common tools in a VC's toolbox, right? Debt belongs to another totally different asset class, right? Even though I started my career in debt. So just for the other people in the room, right? So debt is on one side, right, of capital that's repayable. Equity is on the other side of capital that's not really repayable unless you sell the company. And then convertibles and mezzanine are in the middle. Basically, they share features of both debt and equity in different proportions, right? So what we're really talking about is debt on one side and equity on the other side. Debt is payable, it's a loan, you owe it, you usually pay interest on it. Equity is not a loan, you're not expected to pay back, you're only expected to give up ownership, some level of ownership to that person, aka in the form of shares. So in terms of being expensive, it depends on the outcome, right? So the question basically Oladimeji is asking, should I take someone's money, not owe them, but give them part of the equity of a company? Or should I tell them I'll pay you back with interest? You would agree with me on the fact that how that company turns out is what would determine which was more expensive, right? In my first firm, we made an investment in a company called Paystack, right? We invested a total of about $50,000 in that company. And when the company was acquired, the receipt was somewhere closer to $1 million, right? Was debt expensive to pay? Was equity expensive to Paystack? Yes, because there's no loan in the world that you would take 50K and pay back 1 million, right? But that's because of how the outcome went, right? Hindsight is vision 2020. So they would have probably wished it was debt, so they could give you even 20% per annum, and then you go away with your 70,000, and that's it, instead of 1 million. But the general advice around debt and equity is only take debt if you can pay it back. And the reason why I say that is because most startup companies do not have a strong enough cash flow to support debt. So if you don't have a cash flow or a free cash flow generating business, it's not the time to take debt generally, right? It's going to lead to problems. It's like someone who doesn't have a job coming to borrow money from you. You usually know how it's going to end, right? So how about he tells you, please, I'm hungry, do give away. And you give him that money and he goes. Or he says, whenever I have money, I'll give it back to you. Or I owe you a favor, right? And so how your business is structured is usually how you know whether debt or equity is good for you. I'll give you a rule of thumb. If your business isn't generating enough free cash flow to service that debt, equity is probably best for you. If your business is generating enough cash flow to service that debt is probably cheaper for you, because then you don't have to give up parts of your company as it gets better. But then it gets complicated later on when you're doing return on investment calculations. You realize that you need leverage, right? And sometimes sharing equity with other people helps you to just get people who are as invested in your company as the rest. That's why VCs do a lot of help for startup founders, because now they own a part of the company and they invested in your success. So sometimes people take equity from investors to lure them in to helping them. And so you just have to think about it like that. But that's the rule of thumb.
Thank you, Olu. Chidioka and Oladimeji, I think that Olu has done a good job answering that question. I'll just move on to the next question from Chidioka, who says that, is there a bias for startups based in Lagos? Simply put, does the place of business matter?
Yes, it does. So as I told you, when we invest, the most important thing you invest in is what? What did I say? Tamilore, can you remember?
People.
Exactly. You invest in people. And there's a reason why Silicon Valley, even in the US, was a hub, right? Almost 40% of the highest valued tech companies came from inside Silicon Valley. And it was because of the people, right? So a lot of times you want to build a company where there's talent to scale. Talent is very, very, very important. And talent is almost a self-fulfilling prophecy. The guys who are really smart, right, want to be hired by the best companies. So they gravitate towards where they think the best companies are. Unfortunately, the best companies also want to be located where there's talent. So it's now a chicken and the egg thing. Thank God for COVID. Not literally, but it's decentralized talent a little bit, at least in other parts of the world, where people can now work from home and those kind of things and are spread. But the truth is, Lagos usually has the highest amount of skilled talent. And that's why a lot of companies gravitate towards that place. If you can hire your team and take them anywhere else, you'll probably build a better team, because you don't want people slaving in traffic and those kind of things. But the reason why it's like that is because there's a hub of talent in Lagos. And that's why there's a bias, right? You need people. You need people to build great companies. And you have to go where most of that talent is. I've lived in Abuja before, so I know what I'm saying.
Thank you, Olu. Thank you for that. Shola Adekunle says, I'm really interested in getting a deep understanding of what series funding entails. Do you want to?
Series funding
Yes.
are just generic names that don't really mean anything, right? But it's always good to just say number 1, number 2, number 3, number 4. And that's what you get when investors or startups name their financing rounds, just to create some type of chronology, right? So usually rule is that the pre-seed rounds, usually when there's nothing on the ground. The next one is a seed round, the Series A, Series B, Series C, whatever, up to F, G, Z, until that company either dies or is acquired. And in between all these, they're crazy names too. Pre-seed extension, Series A extension, pre-Series A, pre-seed, post-seed, seed extension, Series B extension, pre-IPO. And so it's just, and there's no clear delineation of how much, the structure, those kind of things. It's one of those things they just say, if you know, you know. And it means different things to different people, right? One company's seed round can be another company's Series A, but usually you get the sense of where they are at, right? Usually a seed, pre-seed or seed stage, this company usually doesn't have a positive cash flow yet. They're still in that stage where they're trying to scale. At Series A, a company has probably achieved what we call product market fit and is now on the way to scaling. Series B, Series C can be considered later stage or growth stage, right? Growth stages of a company. And by looking at companies and what they name their series, you might get a sense of the developmental stage they are in. But as I said, they're general names, so feel free to throw it anyhow you like.
Anonymous says, what is your advice to a startup that is centered around creating a centralized market for the sale of dogs and pets in Nigeria?
The same thing that I told you initially. Who are the guys running it? Do they know about keeping, do they know enough about what people like to buy in dogs and pets? Are they pet lovers? Increases their chances of success. What's the second thing I said? What's the total addressable market? How many people are buying dogs and pets in the country, right? How many people are buying dogs and pets in the country? Is the product something that people will use? Probably. There are more dogs and pets than it was 10 years ago, right? So it's probably a good business at this time because it's growing, pet ownership is growing. But again, what's the TAM? I don't know, right? My guess is that it's probably 5% of the country that can afford pets at this time. You know, we live in a bubble in Lagos and we think everybody has a smartphone and is rich enough to feed themselves and a pet. But if you do the research and you think that total addressable market is big enough, I think it's actually a bright idea. It's coming of age in the country.
Thank you, Olu. So I hope you've gotten your answer. So you need to do some research around the markets and market for your idea. Anonymous says, is there any specific difference between general conservative investors and venture capitalists? Do VCs invest purely in yielding products like loans?
Do VCs invest purely interest yielding products like loans?
Yes.
Short answer is no. We're not created to invest in loans, right? Sometimes VCs can do it in addition to equity just to bridge a funding gap, right? But VCs are not the place to go for loans. We don't do loans. We don't record interest income on our books. We are there for the long run. We're there for the big, audacious dreams, right? We're not there to say, oh, I'll give you 15K, you give me 20K tomorrow. No. And so we don't do loans. If you want a loan, you might have to go to a lending company or a bank, right? We usually want to be part of the journey and celebrate together or cry together if the company succeeds or fails. I hope I answered your question. Anonymous.
So I have another anonymous. I think this is the person who asked about the debt mezzanine distinction. This person says, piggybacking off this question, as a VC, in what situations would you opt for a mezzanine finance option or a mix between debt and equity? That is a situation where there is convertible, a repayment obligation, and you also own shares in the target company and can exercise decision-making rights in the company as well. What qualities or risk of the target company would you look out for to prompt you to make use of this sort of investment structure?
So a lot of times, as I said, right, first of all, let me start from the back. We're not in the business of making decisions for companies, right? VCs will only step in, one, to give advice to the founder. The founders are supposed to run the companies. There's a reason that why the founders are not us. So they're best placed for it. We're not there. Any VC who, or anyone who calls themselves a VC and is trying to take decision-making power, share decision-making power with you, you shouldn't take their money. They're not VCs, they're not properly trained. VCs are there to create an environment for founders to do their thing, right? And give advice or guide. That's the first thing. So if you see that, red flag. The second thing is that you spoke about is, yes, we don't usually use mezzanine, but we use convertibles. And for the benefit of the audience, your masterclass has started. Convertible notes are usually loans that can change form into an equity investment during a triggering event. Basically, something must trigger it. Basically, sometimes it's the maturity of the convertible note, or it's a fundraising event, or it's when you reach a certain revenue milestone, but it usually has a trigger, right? So basically, this is me saying, hey, Tamilore, I'm going to invest 15,000 Naira in your company, right? And at so date, I would have the chance to choose if I want to convert it into a 15,000 Naira investment. So a convertible note is not built to be a note. It's actually built to be equity, right? It's not built to be a loan. It's actually built to be equity. And that's why it's convertible, right? VCs use it to limit their risk a lot of times, to limit like the downside. But what usually happens is that, as I said, the only times we think about this kind of products are times when it's bridging a gap. A lot of times it's between now and a qualified financing round, right? And so what you have a lot of times is that we give you a convertible note because there's so many uncertainties. What's your company valued at? Do you have the time to start to create equity agreements at this time? So we give you something that just says, hey, go on your adventure. When we get to a clearer point, we can decide what this is going to be, right? And that's why it has so much flexibility, because we just want to put money in the hands of the founder to go and build that thing, because time is of the essence, right? And so, as I said, it's not built to be a loan. It's built to be equity. Anybody who doesn't convert their convertible note into equity, usually it tells something about how that business is going or what their perception of the future of that business is. And it's not a good sign. It's actually built to be equity. I hope I answered that question.
Yes, I think you did. So we have another question. So this person says, I may have missed this part, it's been discussed, but how do you obtain the funds you lend to investors? Do you get from banks and then only lend to investors? I think this person actually means how, so basically how as a VC firm, you actually get the funds you invest in startups, because I don't think this is
Okay.
lent to investors.
Yes. So contrary to a lot of beliefs, right? People, and I understand that it's a really opaque process, right? People see VCs as this guy is sitting on his high horse and sitting on all this money and thinks he can decide the lives of other people. But each time you go and pitch to a VC, remember that VC, for every pitch I receive or a member of our team receives, we actually do another pitch to people we call limited partners. These are the guys we get money from. So I have a deck just like you. My hands start to shake just like you. And we go and raise money from people who have, let's just say, excess liquidity, right? And we raise this money from them on a long term, right? The people VCs usually raise money from are high net worth individuals, family offices, university endowments, in the US, pension funds in Nigeria don't invest in VC, right? I guess the financial markets is still underdeveloped and probably they just don't understand it, right? Pension funds, all these pools of capital, we go to them, pitch you, the founder, and say, hey, we have great opportunities. We have great founders in this area, in this vertical, right? And this is how we're going to deploy it. This is how we're going to return your money. So VCs go to investors And if you're a high net worth individual, you can actually invest in a VC fund, right? People in VCs go and pitch to these people and get investments and pull, then it creates that pool of capital that they eventually invest in these companies. And when the money comes back, hopefully it comes back in tenfold, then they distribute this money back to those investors and take a piece of it. So this is really how it works. So VCs pitch a lot too, and that's why they recognize a bad pitch when they see it.
Thank you so much, Olu. I see that we still have a number of questions, but we need to wrap up the session. And so what we're going to do is that we would address these questions and publish them on our social media pages. I know that a number of people have asked whether the recording would be available. Yes, we will be posting the recording from the session on our social media pages as well. Thank you, Olu. It's been a very, very insightful session today. I feel like I've learned a lot, and I'm sure everyone who's watching has probably definitely learned a lot as well. So thank you so much for taking our time to be on this month's edition of the Insider series. We definitely look forward to collaborating with you, getting that training session you mentioned, to better understand your deal structure.
It's not free.
I'm sure we can definitely discuss that offline. But thank you so much, Olu. I would like to say a big thank you to every member of the Oui Capital team as well, who worked behind the scenes to ensure the success of today's session. And a big thank you as well to every member of the startup practice, Alukwano startup practice, Ida Rome, Adeteji Odundun, Adeola, everyone. Shout out to Ina. Thank you so much for working hard to ensure that the series for today was successful. I feel like everyone must have learned one or two things. And like Olu said, our MBA class has started. So this is for you to go back, do some further reading. And I'm sure you can, I don't know whether or not to drop your social media page. And I'm sure you'll be happy to also answer whatever questions you have. So thank you so much. Till we come your way next time with the next session of the Insider series. Please stay safe and have a good day. Thank you.
Thank you very much. Lastly, my Twitter is the Afro VC, one word, the Afro VC. My Instagram is for personal shenanigans. If you reach out to me there, if I have some time, I will be able to answer some of those questions. And sometimes I tweet things that you might be able to learn from.
Thank you. So I hope everyone has gotten his Twitter handle and you're able to shoot questions. So thank you, everyone, and have a good day.
Thank you very much, Tamilore. Have a good day, everybody.